In 2025, the average American homeowner was sitting on what appeared to be the greatest paper wealth in history. Home values had doubled in just 5 years. Equity statements looked like lottery tickets, and the financial press was calling it the strongest housing market of the modern era. That narrative is now mathematically broken. This is not a prediction. It is not a forecast built on speculation or worst-case modeling. It is the mechanical result of 4 converging pressure systems that are now hitting the American housing market simultaneously for the first time in recorded economic history. What is unfolding is not a correction. It is a structural repricing of the largest asset class in the United States. And the window to act before that repricing becomes visible to the general public is closing faster than anyone in the mainstream press is willing to admit. Before we walk through the specific data points that define this moment, understand what this analysis is not. It is not a headline designed to generate anxiety. It is not a political argument. It is a structural examination of how capital flows, leverage cycles, and policy decisions combine to produce outcomes that feel sudden but were, in retrospect, entirely inevitable. The first pressure system is the one most people partially understand, the affordability collapse. But the numbers are more severe than the headlines suggest. In 2021, a household earning the median income of $70,000 could qualify for a home at the median price with a monthly payment consuming roughly 28% of their gross income. That is the traditional affordability threshold used by every mortgage underwriter in the country. By early 2025, that same calculation had completely inverted. The median home price had reached $420,000. Mortgage rates had settled into a range between 6.5% and 7.2%. Property taxes and insurance, which we will address in detail shortly, had surged independently of the purchase price. The result is a monthly all-in payment that now consumes between 52% and 61% of the median household's gross income. This is not house poor. This is structural insolvency disguised as homeownership. The mortgage underwriting system was built on the assumption that no sustainable market could persist when carrying costs exceed 35% of gross income. We are now running 25 percentage points above that ceiling and calling it a stable market. It is not stable, it is frozen. And a frozen market is not the same as a healthy one. Transaction volume in the existing home sales market fell to its lowest level since 1995 in 2024, a data point that deserves far more attention than it has received. In 1995, the United States had 70 million fewer people. The collapse in volume is not seasonal, it is structural. The market has essentially stopped functioning for the median buyer, not because there is no desire to transact, but because the mathematics of the transaction have become impossible for the majority of participants. The second pressure system is what economists are beginning to call the lock-in trap, and it represents a mechanism that has no modern historical precedent at this scale. Approximately 85% of existing American mortgages carry interest rates below 4%. The current market rate sits between 6.5% and 7%. For a homeowner with a $300,000 mortgage balance at 3.5%, selling that home and purchasing a comparable property at current rates would increase their monthly payment by over $900. That is not a small number. That is a car payment on top of a mortgage payment every single month for 30 years. The rational response to that incentive structure is to not sell, and that is precisely what is happening. The lock-in trap has created an inventory crisis that is entirely artificial and entirely unsustainable. It is keeping prices elevated not because of genuine demand, but because the supply of homes available for purchase has been frozen by financial self-interest. The National Association of Realtors reported that existing home inventory in early 2025 sat at roughly 3.5 months of supply. A balanced market requires 5 to 6 months. The inventory shortage is real, but its cause is not what most buyers assume. It is not a construction deficit. It is a rate-induced paralysis on the sell side. And the critical point is this: paralysis is not permanent. It breaks. It breaks because life does not pause for mortgage rates. Divorce proceedings, estate settlements, job relocations, medical emergencies, and financial distress do not consult the Federal Reserve's rate schedule before proceeding. Every month that passes, the 4 economic forces that override the lock-in incentive accumulate more victims, and when that inventory dam begins to crack, the released volume will hit a buyer market that is operating at a 30-year low in qualified demand. The collision between forced supply and collapsed demand is not a forecast, it is a scheduled event. The question is not whether it happens. The question is which quarter of which year it becomes impossible for the mainstream narrative to deny. The third pressure system is the insurance crisis, and this is the variable that is most severely underpriced by the market. It is also the mechanism that will accelerate the timeline of repricing in ways that mortgage rate movements alone could not achieve. State Farm, the largest homeowner insurance carrier in the United States, made a decision in 2023 that received significant coverage in the trade press but almost none in the financial press. They stopped writing new homeowner policies in California entirely, not in wildfire zones specifically, in the entire state. Allstate followed, then Farmers, then a cascade of regional carriers across Florida, Louisiana, coastal Texas, and large portions of the Southeast. As of 2025, 7 states are experiencing what insurance regulators are now classifying as availability crises, meaning that a standard 30-year conforming mortgage cannot be originated in significant portions of those states because the mandatory insurance component of the transaction cannot be obtained at any price through the standard market. Florida is the clearest case study in what this looks like in practice. The average homeowner insurance premium in Florida in 2019 was approximately $119.60 per year. By 2025, the statewide average for policies that could actually be obtained had crossed $11,000 annually in many coastal counties. That is not a rounding error. That is a structural shift in the economics of ownership that happened almost entirely outside the awareness of the national housing narrative. In Lee County, where Fort Myers sits, the average insurance premium in 2025 represents a larger monthly payment than the principal and interest on a mortgage originated at 2021 prices. The carrying cost of a home has been effectively doubled by a variable that does not appear in any mortgage advertisement, any Zillow listing estimate, or any Federal Reserve interest rate analysis. The financial mechanism of this crisis is particularly dangerous because of how it interacts with the mortgage system. A property cannot carry a conforming mortgage without hazard insurance. If insurance cannot be obtained through the private market, the owner is routed to the insurer of last resort, the state-run Citizens Property Insurance in Florida, the FAIR plans in California and other states. These state programs are designed as temporary backstops. They are not capitalized to handle systemic losses. The Florida Citizens Program currently insures over 1.3 million policies and carries an exposure that exceeds its reinsurance capacity by a margin that its own actuaries describe as a stress scenario. If a major hurricane makes landfall in a populated area during the 2025 or 2026 season, the actuarial model suggests that Citizens would require a special assessment levied on every single insurance policyholder in the state of Florida to cover its losses. Not just property owners, every insured person in the state. This is not a scenario being discussed in any serious way in the residential real estate market. It is being priced in silently and mechanically by the capital markets. Private equity firms that were active buyers of Florida residential real estate in 2021 and 2022 have quietly exited net buying positions and moved to net selling. They are not announcing this. They are executing it in the transaction data. The fourth pressure system connects directly to the behavior of the institutional capital that helped inflate residential prices in the first place. Between 2012 and 2023, institutional investors, including Invitation Homes, Progress Residential, and smaller regional operators accumulated an estimated 500,000 to 700,000 single-family homes across Sunbelt markets, including Atlanta, Phoenix, Dallas, Charlotte, and Tampa. These acquisitions were justified by a simple financial thesis. Rising rents, appreciating values, and cheap debt would combine to produce returns in the 8% to 12% range that satisfied institutional capital mandates. All 3 legs of that thesis have now inverted simultaneously. Rent growth in single-family markets peaked in mid-2022 and has decelerated sharply. In several markets, including Austin and Phoenix, asking rents are now below their 2022 peak in nominal terms, meaning they are deeply negative in real terms after accounting for the inflation that has occurred over the same period. Property values, while still elevated at the median level due to the inventory freeze, are declining in the markets with highest institutional concentration. And the debt that financed these portfolios was not the fixed 30-year mortgages that individual homeowners use. Institutional portfolios were funded with floating rate credit facilities and short-term securitized debt instruments that reprice with the market. When rates tripled, the cost of servicing these portfolios tripled with them. The Wall Street Journal reported in late 2024 that several major single-family rental operators were generating negative cash flow at the portfolio level, meaning the rental income was no longer covering the operating expenses, debt service, insurance, property taxes, and maintenance costs. A real estate investment that generates negative cash flow is not an investment, it is a liability with a cost basis. The institutional response to sustained negative cash flow follows a predictable sequence. First, reduce new acquisitions. That happened in 2023. Second, optimize existing portfolios by selling the weakest assets. That is happening now. Third, if conditions do not improve, execute a broader liquidation of positions to return capital and reduce balance sheet exposure. The timeline between Stage 2 and Stage 3 in institutional capital management is typically 12 to 24 months from the point of cash flow deterioration. By that math, the institutional selling pressure in Sunbelt single-family markets is not a future risk. It is a present reality that has not yet shown up in the headline price data because of the volume suppression created by the lock-in trap on the individual sell side. When both of those seller pools activate in the same market simultaneously, the clearing price will bear little resemblance to the current listed price. Markets do not find equilibrium gradually. They find it in steps, often violent ones, when the gap between perception and reality becomes too large to maintain. Now consider what connects all four of these pressure systems and why they are more dangerous in combination than they would be individually. The traditional defense of elevated home prices has been the strength of the labor market. The argument is simple. As long as people have jobs and income, they will find a way to service their mortgages and prices will hold. This argument has been partially correct for the past 3 years. It is becoming less correct every quarter. Unemployment claims began their structural rise in the second half of 2024. The labor market that was absorbing excess workers at unprecedented rates through 2021 and 2022 has shifted into a mode where job openings are declining faster than workers are separating from their positions. This is the precise early-stage dynamic that precedes unemployment rate increases with a typical lag of 6 to 9 months. The industries with the highest concentration of mortgage stress, construction, finance, retail, and logistics are also the industries showing the earliest signs of employment deterioration. A homeowner who bought at peak prices with a peak rate mortgage does not have a large buffer for an income disruption. The average loan-to-value ratio at origination for mortgages issued between 2022 and 2024 sits above 90%, meaning the equity cushion that historically insulated homeowners from forced sales in a downturn is structurally thin for a significant portion of recent buyers. When an income disruption hits a homeowner with 8% or less equity in a market where prices are beginning to soften, the forbearance programs and loss mitigation tools that servicers use can delay but cannot prevent a resolution. The resolution is either a distressed sale or a foreclosure. Neither outcome is positive for the neighborhood price discovery process. The credit market is reading this data in real time, and the pricing signals it is sending are worth examining carefully. Mortgage delinquency rates on loans originated in 2022 and 2023 are running meaningfully above the delinquency rates on equivalent vintage loans from prior cycles at the same point in their seasoning curve. This is the kind of data that does not appear in press releases or earnings calls by mortgage servicers. It appears in the Federal Reserve Flow of Funds report and in the FFIEC mortgage performance data published quarterly. The signal is clear. The loans made at the top of the affordability cycle are deteriorating faster than comparable loans from prior cycles. This is not a 2008 repeat in terms of underwriting quality. These borrowers documented their income. The issue is not fraudulent qualification. The issue is that accurate income documentation at the time of origination does not account for an economy that is decelerating, an insurance market that is repricing, a property tax system that is reassessing, and an equity cushion that is too thin to absorb simultaneous pressure from multiple directions. The property tax dimension of this conversation is one of the most undercovered components of the affordability collapse, and it is worth examining in structural detail. When home prices doubled between 2019 and 2022, property tax assessments in most jurisdictions followed with a typical 12 to 24-month lag. States that perform annual reassessments have already delivered the full shock. California, which limits annual reassessment increases for existing owners under Proposition 13, has partially insulated existing owners but created a massive tax cliff for new buyers who are assessed at current market value. In Texas, where there is no income tax and property taxes are among the highest in the nation, the reassessments following the pandemic-era price surge have added $4,000 to $8,000 annually to the carrying costs of homes in major metro markets. For a homeowner who purchased a Dallas area home in 2021, the combination of the original mortgage payment, the insurance premium increases, and the property tax reassessment now produces a monthly all-in carrying cost that is between 35% and 45% higher than it was at the time of origination. That buyer did not take on adjustable rate debt. They did not experience a job loss. They simply stayed in their home while the fixed and semi-fixed components of their carrying cost expanded around them. The margin of safety that existed at origination has been consumed by these structural escalations, and there is no mechanism to reverse them. Property taxes do not go down when home values decline unless the owner files an appeal, a process that is administratively burdensome and typically lags market reality by 12 to 18 months. Insurance premiums that have been adjusted for climate-related risk do not return to prior levels when a year passes without a major loss event. The repricing in these markets is permanent until the underlying risk calculus changes, and the scientific and actuarial consensus suggests that underlying risk is increasing, not decreasing. Zoom out from the individual household balance sheet to the banking system that holds the mortgage collateral, and the picture becomes structurally more complex. Regional banks hold approximately 65% of outstanding residential mortgage debt in the United States. These same institutions are simultaneously dealing with significant unrealized losses on their commercial real estate portfolios, tightening net interest margins as deposit competition intensifies, and a regulatory environment that is moving toward higher capital requirements under the Basel III Endgame proposals. A regional bank managing all of those pressures simultaneously has a limited appetite for absorbing new stress from residential mortgage deterioration. The extend and pretend strategy that was applied to commercial real estate in 2022 and 2023, granting loan extensions to avoid marking losses, was feasible when the stressor was isolated to a single asset class. When the stress becomes visible across multiple asset classes simultaneously, the capacity to manage through it decreases, and the probability of institutional decision-making shifts that create cascading effects increases. The Federal Deposit Insurance Corporation's 2024 Problem Bank List, which tracks institutions with heightened supervisory concern, showed an increase for 3 consecutive quarters. That trend is not a crisis in isolation. It is a leading indicator of a credit environment that is tightening for the most interest rate-sensitive borrowers, which in 2025 means virtually every prospective home buyer who does not have substantial equity from a prior transaction. The construction side of the housing equation is adding another layer of mechanical pressure that is not yet reflected in headline inventory numbers. The surge in new home construction that occurred between 2020 and 2023 in response to the perceived inventory shortage is now delivering its supply into a market environment that is radically different from the one that justified the construction decision. Builders in markets like Phoenix, Austin, Nashville, and Tampa are sitting on completed inventory that is growing quarter over quarter. To move that inventory, they are using mortgage rate buydowns, price concessions, and incentive packages that effectively reduce the actual transaction price while preserving the nominal listing price. The Federal Housing Finance Agency's Repeat Sales Price Index, which tracks the same properties over time and provides a more accurate picture of real price changes than median price metrics, is already showing deceleration in the markets with the highest new home inventory. The builders are not victims in this narrative. Their own land acquisition and construction financing decisions created the supply overhang. But the resolution of that overhang will not happen at prices that keep regional bank balance sheets whole, and the builders know it. That is why D.R. Horton, Lennar, and other large publicly traded builders have been conservative in their public guidance for 2025 and 2026, despite reporting strong current results. Their management teams understand that the forward demand environment is structurally constrained in ways that the trailing 12 months of sales data does not reveal. The geopolitical layer of this housing analysis receives almost no attention in the domestic real estate press, and yet it represents a meaningful and growing variable in the forward equation. Tariff policy changes in 2025 created significant input cost inflation for the materials that go into residential construction. Lumber, which had experienced a partial price normalization after the 2021 peak, began re-escalating in the first quarter of 2025 as uncertainty around Canadian trade relationships introduced a risk premium into the forward pricing of structural materials. Steel and aluminum tariffs, reinstated and expanded as part of broader trade positioning, added between 4% and 8% to the cost basis of new construction in markets dependent on those inputs. This is not a temporary adjustment. It is a structural shift in the cost floor for new housing that simultaneously prevents builders from cutting prices to market clearing levels and reduces the affordability of new supply for the buyers who need it most. The irony of a policy designed to protect domestic manufacturing is that its most immediate measurable impact is on the cost of domestic housing, the asset that the bottom 70% of the income distribution depends on as its primary wealth accumulation mechanism. Capital does not resolve irony, it prices risk. And the risk being priced into the forward construction market is the risk of a sustained period in which the cost to build exceeds the price the market will support, which means new supply will not be built, which means the affordability crisis extends into a horizon that no current policy framework has a credible plan to address. The municipal finance dimension of housing market stress is the final systemic variable worth examining before we turn to what happens next mechanically. Cities and counties that experienced the most dramatic home price appreciation between 2019 and 2022 built their budget models around property tax revenues derived from those elevated assessments. When transaction volume collapses, as it has, the reassessment cycle slows because there are fewer arm's-length transactions to establish market value benchmarks. But the spending commitments made on the basis of peak revenue projections do not slow with the assessment cycle. The result is a growing structural gap between committed expenditure and realizable revenue in exactly the municipalities that are most exposed to housing market stress. This matters for individual homeowners because the municipal response to revenue shortfalls is not to reduce services. It is to increase rates on whatever tax bases remain accessible. Property taxes, utility fees, and local assessments are the levers that municipalities control without state or federal authorization. Several counties in California, Florida, and Texas have already approved above-average property tax rate increases for fiscal year 2026 precisely because the assessment-based growth they were projecting has not materialized. The homeowner who feels the inflation of insurance, the plateau of equity, and the increase of carrying costs is not experiencing a collection of unrelated events. They are experiencing the convergence of a single systemic process, the unwinding of a leverage and liquidity cycle that inflated every component of housing costs simultaneously and is now deflating them on different timetables, creating maximum confusion and maximum pain for the household trying to navigate it in real time. What happens next is not a prediction. It is a mechanical description of what the data shows is already in motion. The lock-in trap will not hold indefinitely. The four forces of death, divorce, debt, and job loss will continue to generate forced sales regardless of rate differentials. Each forced sale at a price below the comparable listed properties creates a comp that expands the range of acceptable prices downward in that neighborhood. As that process accumulates, the appraisal system begins to reflect it, which constrains the mortgage amounts available to buyers, which reduces the ceiling price achievable in any given transaction, which feeds back into the comp structure. This is how residential real estate corrections propagate. Not in a single dramatic event, but in a sequence of mechanical steps, each of which lowers the floor for the next. The insurance market will continue to contract geographically as reinsurance capital, which is global and highly rational, prices the actual risk of catastrophic weather events in regions where that risk has been structurally underpriced for decades. The markets that have already experienced insurance availability crises are not anomalies. They are previews. The actuarial models are running ahead of the political response and the real estate market narrative, as they typically do. The institutional sellers will execute their liquidation programs on the timelines dictated by their fund structures and investor obligations, not on the timeline that is most convenient for the markets in which they are selling. And the credit deterioration in the 2022 and 2023 mortgage vintages will continue to season, producing delinquency and default rates that will eventually force servicers and regulators to move beyond extend and pretend into actual loss recognition. None of this is simultaneous. None of it is instantaneous. But all of it is in motion, and the direction of motion is uniform. The pressure is converging from every structural angle simultaneously toward a single destination: lower clearing prices for residential real estate in the markets, most exposed to the combination of affordability collapse, insurance retreat, institutional selling, and credit deterioration. That destination is not a cliff. It is a slope. But it is a slope that the data suggests is steeper than the mainstream narrative has yet acknowledged. The question for anyone who owns residential real estate in 2025 is not whether to pay attention to this convergence. It is whether the specific characteristics of the property they hold place them in the path of the structural forces that are now unfolding or outside of that path. Not all markets are equally exposed. Properties in the interior Midwest with stable insurance markets, low property tax escalation, and limited institutional ownership concentration are experiencing a structurally different risk environment than a condominium in a Florida coastal county where the insurance market has effectively withdrawn and the property tax assessment has not yet caught up to the coming correction in comparable sales. The granularity of this analysis matters because blanket decisions in either direction, sell everything or hold everything, reflect a level of simplification that the actual data does not support. What the data does support is a rigorous, dispassionate examination of the specific cost structure and exposure of each individual property against the structural forces that are in motion, followed by a decision process that is informed by that analysis, rather than by the emotional attachment that residential real estate invariably generates. The house is not the home. The home is the people in it. The house is a financial instrument. In 2025, evaluating it as anything other than a financial instrument is a decision with real economic consequences that will become visible in the data over the next 18 to 36 months. The process is unfolding. The data is accumulating. And the window between now and the point where that data becomes the mainstream narrative rather than the fringe analysis is the window in which decisions about residential real estate exposure have the most optionality attached to them. Follow the data. The mechanics do not require your belief to operate. They require only your attention.